Rule number 11, enter early. Well, this goes against almost everything that's ever written about trading in the universe. What do I mean by entering early? I mean, enter so early that it almost kind of looks stupid. Let me give you an example. Let's say you've identified 20 companies, and in these 20 companies, they all have rising earnings, positive outlooks, they're raising their forward guidance, they have free cash flow that looks really good, they have a good current ratio. The current ratio is the measure of how many dollars in cash does the company have for every dollar of short-term debt. A high current ratio is a really great thing to see. So let's say you've identified 20 companies with great current ratios, with rising earnings, with earnings transcripts that show that the company is doing well, and yet that company's been falling. And then one day, the company falls a lot. It gaps open lower. If you take the buy trade at that point, you're doing what almost no one in the world would do. You're entering early. But because you're obeying trade rule number 2, you've reduced your trade size. It doesn't matter that you've entered early. Here's what happens when you enter early, and I know this is going to sound crazy. You have made it virtually impossible to be the worst buyer of that stock. You've bought at the absolute, likely lowest price. Things recover after an exhaustion move, but it's the scariest time to buy a stock. Those gaps open lower. Those Morningstar, Doji, those tiny little candles at the bottom, those denote a turnaround. And especially for a company that's healthy, that's making money, those are the days to enter. Those are the moves that you can enter on. It's scary, but because you've reduced your trade size and you know you're going to cut your losses, it doesn't set you up for a lack of success. It sets you up to have the best price that anyone else can get.